Hello, everyone. Welcome to Private Asset Management's Virtual Economic and Financial Market Outlook. My name is Alex Dietz. I work in the research team as an analyst, and I'll be the host for today's event. Our presentation is going to be roughly 45 minutes long, with an opportunity to get some of your questions answered at the end of the presentation. If you want to ask a question, go ahead and use the Q&A function in the webinar, and feel free to submit the question at any point during the presentation. With that being said, I'd like to introduce our two speakers for today's event. I'm sure a lot of you have heard of or met or seen one of these presentations before and know our Chief Investment Officer, Jeff Witt. He will be covering financial markets per usual. Given COVID's impact on the economy, we also thought it'd be a good idea to include our Chief Economist, David Allen, just to go over his views on the economy. So before we get started, I'd just like to remind you that the views and opinions expressed herein are, as of the date recorded, should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Private Asset Management or its affiliates and are subject to change without notice. Private Asset Management has no obligation to provide updates or changes. With all that being said, let's get started. David, I'll hand it off to you.
Great. Thank you, Alex. And thank you all for being on the webinar today. I know that the three of us really welcome the opportunity to discuss economics and financial markets. And we're certainly all looking forward to our Q&A at the end of our presentation today. In my economic portion of the presentation, I'm hoping to facilitate some of that Q&A. I'd like to provide first just a review of what we've seen in the U.S. economy over the last year or so. And then offer our near-term outlook for the economy, and then transition to what I think are three of the biggest topics in the U.S. economy today, beginning with our outlook for U.S. monetary policy and fiscal policy, and then looking at our outlook for inflation, and then finally offering our assessment of the conditions in the U.S. housing market. Let's jump into it. So first beginning with where we've been. This is a look at quarter-over-quarter growth at a seasonally adjusted and annualized rate in the U.S. economy. The black dots on this chart are those growth rates, and then the stacked bar charts show the contribution of each major category of output to overall growth. And as you can see, sort of at the second half of 2019, the economy was growing nicely, above estimated potential growth rate of somewhere between 1.8 and 2%. So we were growing above that in the second half of 2019. However, in the first quarter of 2020, though growth early in the quarter remained strong, the pandemic did reach the U.S. economy late in the quarter, and that was enough to lead to a 5% contraction, which is large from a historical perspective, but paled in comparison to the decline that we saw in the second quarter of 31.4%. During this period, we saw social distancing recommendations put into effect, and restrictions on businesses spreading across the country, leading to dramatic job losses. In the third quarter, we rebounded sort of equally as strong strongly from a historical perspective, but there was quite a bit of government support during this period, and also generally improving public health conditions. In the fourth quarter, unfortunately, those public health conditions worsened. We saw more restrictions put in place, though the government was still supportive in terms of providing stimulus to the overall economy, and we ended up with about a 4% growth rate. So over that period of time, where does that leave us in the U.S. economy in terms of output? So peak to trough, so the peak being in the fourth quarter of 2019 and the trough being the second quarter of 2020, we saw a greater than 10% decline in overall output. Since then, so the third quarter and the fourth quarter, we've regained much of that ground. So we saw an 8.5% increase from the nadir in economic output, but we're still about 2.5% below where we were at the end of 2019. I mentioned there that we've seen some dramatic job losses, and these are job losses that are despite some of the government support, particularly the payroll protection program, which was meant to keep employees attached to their employers, though restrictions are put in place. So, but in spite of that, we've seen historic job losses in March and April, totaling over 22 million. Quickly, though, in May, we saw payrolls added back into the labor market, 11 million from May to August. over that 4-month period, that's a 2.75 million monthly payroll average gain. Since then, job growth has been somewhat slower, just 1.5 million jobs added from September to January. Over that 5-month period, that's about a 300,000 job gain on a monthly average. So in total, we're still well below where we were prior to the pandemic. Non-farm payrolls are still about at a 10 million job deficit relative to the February 2020 levels. To provide some perspective on that level, at sort of the worst state of during the financial crisis in terms of job losses, we were about 10 million. So despite all the jobs that we've added back into the labor market since April of 2020, we're still at a place where we're sort of equivalent with where we were at the worst point of the financial crisis. So this next chart offers us an opportunity to look at where job losses relative to the February 2020 level have been concentrated. I think there are some of these worst performers, there's no surprise. Leisure and hospitality, which has suffered from restrictions on dining at restaurants, as well as travel restrictions. That's where losses have been the greatest, nearly 4 million jobs lost relative to the February 2020 levels. Health and education services also a big deficit there of 1.3 million. But I think what might be more surprising is that we've seen losses, relative to pre-pandemic levels, are continuing in sectors of the economy that we may think are performing relatively well. Specifically here, I would call out information and construction, which are industries which I think we regard as performing well during the recovery. But we still see job deficits there of about 250,000. So it's pretty broad-based weakness across the labor market. These job losses have translated into historically high unemployment claims, peaking at almost 33 million in June of 2020. We've seen declines there, down to 18 million in the most recent data. However, a normalized level of this, sort of prior to the pandemic, was about 2 million. So we're about a factor of 10 still above what we would consider a normalized level of unemployment claims in the labor market. One more point I wanted to make related to the labor market here is on the unemployment rates. We saw the headline unemployment rates, called the U3 rate, peak at 14.8% in April. It's come down considerably, as it's been welcomed to see that. We're down to 6.3% in the most recent data. We do expect this is going to continue to fall, perhaps reaching 5% by year end, but further progress back to estimates of full employment might take until 2023. But I'd also like to offer that maybe there's a better measure of the remaining slack in the labor market, and that would be the U6 rate, or what's called the underemployment rate. Under this U6 rate includes not just those who are unemployed, but those who are also marginally attached, meaning that they are not currently looking for a job and are therefore not recorded as unemployed in the official data. But if a job were offered to them, they would accept it. And also, the underemployment rate includes those folks who are part-time for economic reasons, meaning they have a part-time position but would prefer to work full-time, but such a position isn't available to them. So the U6 rate increased almost 23% in April, and it's down to 11.1%. I think that's probably a more accurate representation of where we are in terms of labor market slack in the economy right now. So now I'm transitioning to where we expect the economy to head over the next 18 months. I'd like to introduce this idea of potential output, meaning the theoretical level of output that the economy should be able to achieve given its endowments of labor, capital, and productivity. And so that potential level, when actual output is above potential, we say that the output gap is positive. However, when the economy is producing below potential, as it is right now, we say that the output gap is negative. And these numbers are all based on estimates from the Congressional Budget Office. So as you can see, we're currently in we have an output gap that is negative, but we do see that continuing to close over the next 5 years. And it's important to note here that this is all based on current legislation. So any additional fiscal stimulus or monetary stimulus or any changes in the economy and the outlook could change this timeline. But it does seem that as things are currently, that we would expect to see the output gap close over the next 5 years, and then that the economy would return to producing above potential as it was prior to the pandemic. On a more granular level, looking here at our estimates of quarter-over-quarter GDP growth over the next 18 months, we're expecting that the economy will perform above potential, so closing that output gap. Potential growth, again, is somewhere between 1.8 and 2%, we estimate. And we're expecting, after a slowdown in growth in the first quarter of 2021, that we're going to return to mid-single-digit pace of growth in the middle of 2021, and then trailing off over the next 3 quarters from 4.3% in the fourth quarter down to 2.9% in the second quarter of 2022. So throughout the next 18 months, we're expecting growth to remain above potential, and we'll be closing that output gap for the duration. This outlook is certainly going to be influenced by quite a few things. I think first and foremost, it's going to be the continued improvement in public health conditions. Right now, that is what that will likely look like is continued vaccination of the U.S. population and improving immunity levels in the population at large. Currently, about 13.3% of the U.S. population has received at least 1 dose of a COVID-19 vaccine, and 5.9% of the population has received at least 2 doses of a COVID-19 vaccine, and would therefore be recorded here in this chart under the fully vaccinated area. At the current pace of vaccination, which is about 1.7 million per day, its model suggests that we could reach a level of herd immunity, sort of the lower end of this herd immunity range that you can see on this chart, that we could reach the low end of that by July. But there's quite a bit of flexibility in that, depending on how things progress over the rest of 2021. For instance, if we approve additional vaccines or achieve some efficiencies in distribution or administration of vaccines, we could reach herd immunity earlier than July. On the other hand, if, for instance, some of the virus mutations that we're seeing spread across the population and vaccines are proven to not be effective in guarding against these virus mutations, then we could see herd immunity delayed until further in the future. So in terms of growth, once we do see improvements in public health, where we're expecting growth to come from is from what is traditionally the driver of the U.S. economy, and that would be the U.S. consumer. And particularly in terms of consumption, we're expecting growth to be strong in the services category. As you can see from this chart, services spending declined more than spending on goods, and it's been slower to recover. And from where we stand now, we're still about 5% below the December 2019 level of services spending. So we expect that the improvements that we're anticipating in public health and increasing immunity levels in the population will support more spending on services, particularly on services like dining and travel, areas that have been the hardest hit during the pandemic. And we expect that those changes will accelerate during the year and be particularly strong in the second half of 2021. Now, it may be a bit of a surprise to sort of, we've talked about the weakness in the labor market, and to sort of be anticipating that the consumer is going to be the driver of growth, that those 2 ideas might be at odds. But I would submit that we've actually seen during the pandemic a pretty substantial improvement in household net worth and improvement in household balance sheets. So as you can see here, overall during the pandemic, through all of 2020, through the first 3 quarters of 2020, we don't have data for the fourth quarter yet, we saw household net worth increased by 5.2 trillion from the pre-pandemic level. A lot of that is coming from rapid home price appreciation that we've seen, as well as improvements in household investment portfolios. And I wanted to point out that this is a big change from what we saw in the aftermath of the financial crisis, which you can see that period of time is circled here on the chart. During that time, we saw a pretty significant destruction of net worth, and that's really not been our experience in the recovery from the pandemic. It's also important, I think, to point out that the growth in household net worth isn't just in liquid assets. I mean, I mentioned home values, I mentioned investment portfolios, perhaps retirement portfolios. These are assets which are not liquid and easy for households to go out and spend in the near term. But we've also seen really significant increases in household deposits. So this is checking deposits or savings accounts. And as you can see at the end of this chart here, those have also increased during the pandemic. So I think a lot of what you're seeing is that a large portion of the labor force has been able to pretty easily transition to remote work. They haven't seen any change in their employment status, and so those government transfers that they're seeing are being saved. And we're also seeing forced spending restraint. I mean, the restrictions that we've seen from a public health perspective have also just curtailed spending. And once we get the improvements in the labor market, improvements in public health that we're expecting, we expect that service spending to increase and consumers to go out and spend the money that they've been able to save over the last year. Okay, so now moving into some of the topics that I think are the biggest sort of economic discussion points today. First, starting off here with our outlook for U.S. monetary policy. As you can see from this chart, the Fed has cut short-term interest rates back to the zero lower bound. We expect that the Fed is going to maintain interest rates at the zero lower bound until at least 2023. That's sort of the earliest date that we can imagine that the Fed is going to be making any change to its interest rate policy, given the current environmental circumstances. Economic circumstances. But I think there's a whole lot of, and that's sort of the earliest. I think there are a lot of policymakers who don't see that we're going to be increasing interest rates until 2024. And I've seen several economist estimates that don't see rate increases until 2025. So this lower for longer environment that we've heard so much about is likely here to stay for the next several years. The other monetary policy tool that I think is important to touch on here is asset purchases by the Federal Reserve. Currently, the Federal Reserve is purchasing $80 billion in treasuries and $40 billion in mortgage-backed securities on a monthly basis. We don't think that there's going to be any change in that policy until 2022. At the current pace of additions to the balance sheet, we could end up with a balance sheet that is roughly $9 trillion by the end of 2021, relative to $7.4 trillion at the end of 2020. And then before we would begin any sort of tapering in terms of asset purchases, we could be closer to 10 trillion. So that should give you some sense of where we see asset purchases and sort of size of the balance sheet growing to before we begin to see some curtailment in the size of the Fed balance sheet. Now moving on to fiscal policy, the biggest point in the fiscal policy discussion right now is this American Rescue Plan, which is working its way through Congress. The headline price tag is pretty eye-popping at 1.9 trillion in additional spending. The legislation includes some direct payments to individuals, as well as support for the unemployed, and then some more controversial issues, including changes to the child tax credit, expansion or growth in the federal minimum wage, and then some support for state and local governments who are looking to close deficits in their own budgets. My assessment is that the 1.9 trillion includes some of these more controversial issues, which it's not clear are going to be able to pass through the budget reconciliation process in the Senate, which will require just a simple majority to become law. The minimum wage, I think, is not clear that it can pass through reconciliation. And also some of the aid for state and local governments perhaps cannot pass through reconciliation. So ultimately, I think the size of the stimulus bill might not amount to the 1.9 trillion that as advertised. It could be something on the order of 900 billion or 1 trillion, but that remains to be seen. We'll just wait for the political process to work itself out as this plan, I expect, will have some sort of change in legislation by mid-March. Even at the 900 billion or 1 trillion price tag for the spending bill that we're expecting, it is likely, well, it certainly will contribute to the deficit in 2021 and add to the federal debt. It's also at that level bigger than the current output gap that we see in the economy. And that's created some pretty reasonable concerns about inflation building in the economy, and that we're going to see inflation rise to harmful levels in the near term. As it relates to inflation, I think I first want to point out that in the actual consumer inflation data, we're not seeing sort of the inflationary forces building as of yet. So this is a look at headline PCE and core PCE. A reminder that core PCE is what the Federal Reserve targets at that 2% level. And both the headline and the core PCE are at pretty subdued levels. Headline at 1.3, core at 1.5. So we're not seeing sort of inflation inflect higher towards a 2% target as of yet. But we are beginning to see in some of the underlying data that will eventually be fed into sort of the top line indices of consumer price inflation, we're beginning to see some of those inflationary forces building. In this chart, you can see the percentage of small businesses who are planning to increase prices over the next 3 months. That historically has been a pretty good leading indicator of core CPI. And you can see that of late, we've seen more and more businesses planning to increase prices, which we do think is going to, over 2021, feed into higher rates of inflation. We've also seen in surveys of ISM manufacturing and ISM services that both sectors of the economy are seeing higher prices for their inputs. And we expect that they're going to be passing on those, to some degree, they'll be passing on those higher prices for inputs onto their end consumers. The other reason that we expect we're going to see higher inflation is that just the year-over-year comparisons are going to be much easier early in 2021. When the pandemic reached the economy, we saw a significant drop-off in demand. That decline in demand led to very low levels of inflation. Just so as we anniversary those, the year-over-year comparison should be pretty easy in the first half of the year, and that could lead to elevated levels of inflation. Increasingly, financial markets are pricing in these higher inflation expectations. We've seen the TIPS spread, which is the difference between the inflation-protected Treasury security and the nominal Treasury increase to 2.2%. Also, another inflation expectation measure, the five-year break-even rate, has increased from 1.6% in mid-2020 to about 2% today. And then finally, as you can see in the chart, that long-term U.S. Treasury yields are beginning to retrace their 2020 declines and are beginning to approach pre-pandemic levels. And then finally, just touching on housing. 2020 was a very strong year for the housing market. I mean, housing in general was one of the highlights in what was at times a pretty dire year. We've seen extremely tight supply in the existing home sale market lead to rapid home price appreciation. Also, there are some pretty significant demographic tailwinds that are stimulating home building. The millennial generation, which is the largest demographic cohort in the US population, is entering their prime household formation and home buying years. And so home building in general, and specifically home building at the entry level, was particularly strong in 2020. And we expect that if mortgage rates remain low and housing affordability remains strong, that 2021 will be another a good year for housing in general and specifically for home building. But as you can see from this chart, the level of new home sales is beginning to approach, for some, worrying levels, levels that we haven't seen since the formation of the housing bubble in 06 and 07. For all of 2020, new home sales were up almost 20% to 815,000 units. We haven't seen those levels again since 06 and 07. We've also seen an acceleration of late. Over the last 3 months, we've seen growth of 882,000 on a sort of an annualized pace over the last 3 months. So it does seem like we saw very strong growth in 2020, but we're actually even entering 2021 at a faster pace. This is, again, raised concerns that perhaps another housing bubble is forming. We would push back on that quite a bit, and I think this chart it goes a long way in explaining why. If you look back at the 06 and 07 period here in the chart, you can see that a lot of the growth in U.S. mortgage origination was at the lower ends of the credit spectrum. On the other hand, today, and what we've seen of late is that it's really at the very highest end of the credit spectrum. That's where mortgage originations are occurring. And so we feel that this, along with higher levels of home equity that U.S. households hold currently, that we're not seeing a housing bubble forming, and that we can feel pretty safe that we're not concerned about a formation of a bubble in the U.S. housing market. So that wraps up my economic presentation. Really, I thank you very much for your time. Again, looking forward to Q&A at the end of our presentation. And now I'm going to turn it over to Jeff, who's going to be discussing our assessment of financial markets. Jeff.
Great. Thanks, David.
Well, I think David did a great job kind of going over really the unprecedented turn in the market last year. We saw numbers that, really had never actually seen before, at least in recent recorded history. Also kind of highlighted how things do seem to be getting better. Markets seem to have passed, or at least the economic market looks like it's past the worst point and starting to improve. We all know that the stock market's a forward-looking indicator, a discounting rate of the future. So it's not a surprise that with the prospects getting better, the markets have really rallied. But that's left to many people wondering, what's an investor to do right now? We've fielded a number of calls recently. People are worried that the stock market's at an all-time high. But when they start looking at, maybe do I need to sell out and reallocate cash? They look at the bond market and see, well, interest rates are at, all-time lows. There's always the prospect of, sitting on the sideline in cash. But as David kind of cautioned, we're seeing some inflationary pressures start to pick up. So that would, obviously degrade the purchasing power of your assets. And also worrisome, there is some signs of froth in the market. So I'm hoping to touch all these points. So, fairly broad-based, discussion here for today. But as most of my topics or talks, I'd like to start off by going over where we are. And this is a chart that's been normalized to 100 for all the broad indices, starting at the beginning of 2020. And so you can see the equity markets really did take a pretty sizable leg down here last spring, reaching its low point in March. But it's since significantly rebound. But that rebound and that recovery has been pretty diverse. We have the Dow Jones Index being up, roughly 11% since the start of 2020. Whereas the NASDAQ being up about 56%. Now, all of these exclude dividends, but you can see that's a pretty wide gap there in the dispersion. Also, kind of highlight here the Russell 2000, which is the green line on this chart. And this represents the smallest of U.S. stocks. That was the laggard, really underperformed right up until the November elections, which also happened to coincide when we got data on the vaccines, which were ultimately approved in early December. And at that point, the smaller cap stocks have significantly outperformed. But with the stock market really running and reaching all-time highs, and really the economy just starting to turn, and the earnings prospects for a number of companies just starting to recover, it's not a surprise that valuations are somewhat stretched. Now, this is a chart that shows the price to earnings ratio of most of the broad market indices, where the earnings are actually the forecasted earnings, so the 2021 earnings. And you can see at the current levels, we're in the fourth quartile on on every one of these indices, the S&P, the Russell, international, both developed and emerging markets. So it's kind of indicative that valuations are at high levels. But here again, the earnings are just starting to recover. So another way to look at this, which goes to seek to try to smooth out the earnings to account for these, the dips and troughs after a recession, is something called the CAPE ratio, or you also hear it referred to as the Shiller PE ratio. And what this does is it takes the earnings and looks at the average earnings over a business cycle. So here over, this chart is over a 10-year period. So it does seek to really smooth out I guess the near-term volatility in earnings. But what jumps out here is that we're approaching levels, here again, that we hadn't seen since really the dot-com era, and it is causing some people to really worry that the market is in a bubble and it is, really, really dangerous to be invested right now. However, we would, I guess, push back against that. And there is a big difference between the dot-com portion or dot-com time frame and where we currently sit now. And and that really is interest rates. And recall, investing is really, a choice of alternatives. We can be invested in stocks, we can be invested in bonds, we can invest in currencies, and how we choose that depends on, what we see as the relative value of each. Now, this is a kind of a busy chart, but it's somewhat important here. The orange line is pretty easy to understand. That's just your yield on the 10-year Treasury. And you can see back in the dot-com era, yields on Treasuries were 6 to 7%, whereas right now, they actually have been recovering, as David indicated, but they're at 1.4%, so really low by the historic perspective. The blue line is a little bit more technical here. This is, remember we just talked about the CAPE PE ratio, so the price of earnings ratio of the stock market with the earnings averaged over 10 years. Now this is the inverse of that, which is called the earnings yield. And what it does is it tries to assume that if all earnings of companies were paid out to shareholders, what would your yield be given the price of the index? And what that does is it makes it kind of a comparison or a comparable to a bond yield. And what to note here is this black line here. This is the difference between the earnings yield and the Treasury yield. And what you can see is during the dot-com era, it was actually the difference was negative, meaning that the earnings yield was actually less than what you could get off of a Treasury bond. Whereas right now, it's pretty positive. The earnings yield on the overall market is higher than what you would see in the Treasury. So looking at a set of alternatives here, and just based off of this, it would indicate that the stock market is actually doing okay, and the worry is actually more in the bond market, that might be a little more expensive. And just to note that this ratio has been negative only a handful of times in the past, once during the dot-com era and another back in the late 1920s. And so it has been a pretty good indicator of, I guess, severe elevation in stock market bubbles. It's one of the reasons that we don't think that there really is a broad-based bubble right now, but more the fact that low interest rates are serving to create valuations a little higher than historical levels. Another reason that we're somewhat positive on the market is deals with the breadth of the market. And normally what happens is toward the tail end of a bull market, you see that the stock market's really being propped up by only a handful of companies. You'll often hear to this being the bull market's running out of steam. Now, this is a chart of the number or the percent of companies of both the S&P and the Russell 2000 that are trading above their 200-day moving average. So it really is kind of showing that this recovery and the rally in stock prices has really been broad-based, and it is not an indication of a late market or late cycle bull, but kind of an indication that things could continue to be fairly robust. And another factor that I think it doesn't get much press here is analysts have been really conservative, I think, in their forecasts of earnings and the strength of the, I guess, U.S. companies to weather the storm. And this chart here represents an earnings surprise. And so that's just the difference between, what companies report in earnings and in sales versus what the consensus estimate was of analysts. And you can see from here that last year was the greatest earnings surprise since, this data only goes back to 2012, but just so since this data even started. And it also is indicative that, analysts seem to be very, very cautious and uncertain on how companies are going to weather this. Now, if this is continuing to be a factor in their estimates going forward for 2021, it might indicate that the earnings portion of that price to earnings multiple is too low, and therefore valuations might not be as stretched. Another factor on this too is, it would be not as telling of an indicator if this earnings surprise was only limited to a handful of companies, but roughly 85% of companies are reporting positive earnings surprises, which was actually the highest level that we've seen since data started back in 1994. So it does look like companies are being really good at weathering this downturn. That being said, I think we all need to get our expectations somewhat in check here. We've seen double-digit earnings or double-digit returns in the stock market over the last few years. That's probably not going to be something that we should be assuming going forward. Now, valuations, I think I've cautioned about this in the past, valuations are not a great predictor of short-term performance, but they do tend to be fairly good at showing what you should expect over more of a long period, and this being the next 5-year annualized return. And you can see kind of a linear downtrend here, that as valuations go up, which is on the x-axis, your expected returns should come down. And where we currently stand is that the bigger black dot on this chart, which is kind of indicative of mid-single digit level returns. And that seems to be coincide with what most major investment banks have out there as kind of their expectations for what we should assume for U.S. domestic returns of mid-single digits. So moving on quickly to the bond market, I always start off with my picture of the teeter-totter or seesaw, depending on where you grew up in the U.S. This is just showing you that as interest rates go down, bond prices go up, and vice versa. So it is really important to understand where we are from a historical perspective on interest rates. I think almost everybody knows interest rates are really, really low. Now, the red line on here is the nominal rate. That's the rate you hear being quoted. And as I said earlier, it's recovered a little bit at 1.4%, I think, about today. But that's off. It's, I think, got to about 0.3%. At the worst of the concerns last year in March. But that's down substantially. I mean, you can see back in the 1980s, 10-year treasuries were double-digit returns, and it's been a pretty downhill slope going forward, or up to that point, or up to this point. That just means that bond prices, are pretty expensive. And the other thing that's somewhat troubling here is the black line, and that's the real rate. So what it does is just take that nominal rate and subtract out the CPI or the inflation data. And you can see where we currently stand. It's improved a little bit since this chart was made, but we're essentially saying that you don't make any yield on a real return, meaning that you're barely, if at all, keeping up with inflation by investing in treasuries, which is not a great prospect to grow a portfolio. Now, what that's doing is it's forcing people out on the credit spectrum to take on additional credit risk to seek higher returns. And this is a spread. This is the difference between interest rates on corporate bonds and high yield bonds relative to treasuries. And what you can see is they definitely spiked up last year when everybody was worried about the economy. But they have since come really forward back down and are approaching historic low levels again. So you can take on additional credit risk, but you're not really being compensated as dramatic as you have in the past for doing so. So the investors really left in a tough spot with respect to fixed income, specifically since interest rates are starting to increase. At the start of the year, the yield on the 10-year bond was about 0.9%. Has increased to about 1.4%. So if you go back to that analogy of that seesaw, the interest rates are starting to go up, bond prices are starting to go down, and so we are starting to see losses in our fixed income universe here. So it is really a tough environment, and as I said earlier, if there is a bubble, it's probably more in the fixed income universe, and those living on fixed income portfolios really face a tough choice. And I guess the best advice that I could have to this area is look at dividend paying stocks. Those are a little more risky than investing in bonds from a capital perspective, but they should help keep up with inflation. You're not necessarily locking in these low levels interest rates. Another thing would be to invest in some more corporate high yield bonds. Economy does appear to be recovering. We have seen default rates falling. So you are taking on additional credit risk, but if you do it in a broader basket of securities, it does help to diversify that risk out. Those also tend to be a little shorter with respect to the maturity of the bonds. And so you'll lock in the rate, but it shouldn't be as long of a time period. So, with that said, let's move on to the froth that we're seeing in the market. Now, I indicated I don't think that there is a broad market stock bubble, and maybe there is somewhat of a bubble in the fixed income universe. At least the valuations look a lot higher relative to stocks. But there is also signs, of some worrying signs in the market. But before we go on, I think the sage advice from Warren Buffett is always good to remember, that of to be fearful when others are greedy and greedy when others are fearful. Now, where we're starting to see some froth, we'll talk about, Alex is going to talk about GameStop here in a second, which I think was an interesting development earlier this year. We're also seeing retail investors come running back into this market, and we're also seeing other frothy areas, Bitcoin being one, which I know that elicits a lot of passionate response. But let's stick with the retail investor here. This is a chart from Bank of America where they showed global equity flows, the amount of retail money flowing into global or into equity funds. And what they found is it hit the highest point ever recorded. I believe this was 2 weeks ago, with the majority of this money going into U.S. equities and the disproportionate going into U.S. tech companies. They also found in a different survey that of their clients, the highest level ever reported that they were taking on additional risk in their portfolio. So this seems to indicate that investors, specifically retail investors, are becoming somewhat complacent with the risk that is inherent in their portfolio, which is always somewhat of a sign of a top to a market. But up to this point, they've done very well. Goldman Sachs created an index which they called their retail favorite, which is the highest level of stocks that are being purchased in retail brokerage accounts. You can see on this chart that it significantly outperformed the broader market in 2020. But they also found that a large portion of these stocks were non-profitable technology companies. These are companies tend to be smaller, that have weak balance sheets and are bleeding cash, which unfortunately sounds eerily familiar to what we saw during the dot-com era. Another interesting, phenomenon that Charles Schwab recently reported on is that we're actually seeing the lowest price stocks outperforming the highest price stocks. Now, this is probably one of the reasons why we've seen the Russell that I mentioned earlier outperform since the November election. Is it looks like once we got news that there was a vaccine right around the corner, you had the retail investor get comfortable enough to start investing. And unfortunately, they've been roughly out of the market for the last 10 years or so. But with them stuck at home, they have a little bit of extra money, as David noted, from some of the stimulus checks or not being able to go out. And they have appeared to have entered back into the market. But they don't have the significant capital. So when they look at investing, they can maybe buy one share of Amazon, given its high share price, or maybe they buy multiple shares of a smaller company, maybe a lot riskier. And this seems to be what's driving these lower price stocks. But unfortunately, these companies tend to be the weakest and the riskiest here as well. So there is signs of froth. There is signs that the retail investor has run back into this market and might be pushing up certain areas to frothy levels. But I don't think it's indicative of a broad-based stock market bubble. But I think it's creating little mini bubbles, but they won't. They don't rise to a level that would create systemic risk. I would say to the overall economy or to the market. But I do caution that thorough equity analysis, fiscal analysis usually balances risk and return on a portfolio. And in doing so, you'll probably underperform during market manias. But I think over a long period of time, taking kind of a diligent, thoughtful approach to investments leads to and has been shown to lead to superior performance. And so I would like to leave with a quote by one of the best bankers the U.S. has ever had, and that being J.P. Morgan. That being, nothing undermines your financial judgment as the sight of your neighbor getting rich, which that I think leads to a nice segue into our next topic of many people falling into that mania with GameStop.
Thanks, Jeff. So before we wrap up and get to Q&A, just wanted to briefly touch on some of that froth that we're seeing in the markets. And, I think the GameStop Wall Street Bet saga kind of illuminates some of that speculative behavior we've been seeing. And so for those who aren't familiar with Reddit, it's basically a social news aggregator, discussion website. And Wall Street Bets itself is a subreddit where retail investors, have been there for years, sharing, exotic stock bets and showing some of the losses, from some of the crazy bets they've taken, and they kind of wear that as a badge of honor. So it's an interesting community. But we've seen some large growth in the amount of people that subscribe to Wall Street Bets or who follow the thread. So the number of subscribers to the subreddit, exploded with the GameStop controversy. It stands at over 9 million today, whereas in December of 2020 there was only about 1.7 million members. But essentially, a few people on Reddit started pitching their idea about GameStop, and more people took notice, and they started to note the massive amount of short interest in GameStop, and they noted that the amount of shares sold short was actually larger than the float, and so they thought a short squeeze could send shares much higher if enough people bought in. And we saw the Wall Street Bets subreddit essentially just go viral, and retail investors rushed into the stock, like GameStop, like AMC, and a lot of them were on Robinhood, and some people made money for sure. I mean, if you had put, this is a graph from Wall Street Journal, if you had put in $10,000 into GameStop on January 1st, it would have been roughly 250,000 at the peak, January 28th. And so, some retail investors surely made a lot of money, but, on the other hand, there are many big losers as well. And say you bought at the very top, it's likely you lost a lot of money. And so this user on Reddit actually posted a screenshot of his account and showing a $10 million loss just on GameStop. And this happened over the course of, 1 or 2 days. And so, you can see that, seeing other people make a lot of money on this GameStop stock brought in new investors, and seeing other people get rich, led them to make some pretty poor decisions here. And so, I think, this is a pretty interesting example of some of the froth we've been seeing in the markets. But I think it's important to note that this type of behavior has largely been contained to small and micro cap stocks. In fact, for the 5 stocks that really took off on Wall Street Bets, there's probably 150 that never launched. So, we think that this type of behavior has largely been contained. But before we get to questions, just, to kind of recap the presentation and what you saw today and how we're thinking about the future, after a severe economic contraction related to COVID and lockdowns, we're starting to see signs that, the economy is healing, and we're seeing, signs of a recovery coming in 2021. Looking into 2021, we expect growth to be above trend, and we think the employment situation should continue to improve. As it relates to financial markets, the stock market is elevated, but we're not seeing broad-based signs of a bubble. In the fixed income market, it's looking a little bit more precarious as interest rates and inflation start to move higher. And lastly, like we said, there are signs of froth in the market, but these are in areas that aren't likely to create a broader systemic problem. So with that, we'd like to go ahead and move on to Q&A. It looks like we have some questions here. Just as a reminder, feel free to send over questions. There's a Q&A chat function in the webinar, so you can send in questions, and we'll try to get to them. But first, David, let's start with this question. I figured this would be good for you. We got a question. So, how has the decline in labor market participation impacted, the overall unemployment rate?
Sure. So, just to start off, so labor force participation is the number of people in a given population who are either employed or unemployed. And so unemployed requires you to be actively looking for a job. And so declines in labor force participation are an indication that people are unemployed and they aren't actively looking. And we have seen declines during the pandemic, similar to what we saw during the financial crisis. So I think there are a couple of narratives for why we may be seeing that. One is that people are they're losing their job at the end of their working life, and they're just sort of deciding, well, I'm just going to go ahead and retire instead of actively looking for new work. Another is that people are just discouraged. They don't feel like there's a job out there for them. That would be somewhat at odds with what we've seen from surveys of some businesses, which indicate they're looking for qualified labor and they're having a hard time finding it. So we have seen that decline. Now, for how that affects the overall unemployment rate. So the U3 rate, which is the headline that is often quoted in the financial media. So if you are not participating in the labor market, you're not going to be included in the U3 rate. That's one of the reasons why I think the U6 rate is perhaps a better measure of the overall level of slack. And so as we bring down the U6 rate, which includes people who would like to have a job but just aren't making the effort to go out and actively look for one, those are people who are potentially able. That's additional slack that's not being represented in the U3 rate, and that bringing that level down is an important goal of monetary policymakers and the federal government.
Great. And I guess just kind of keeping on this topic, I mean, what are your thoughts of the proposed increase to minimum wage? I mean, and how does that affect, unemployment or, job growth moving forward?
Yeah, sure. So the increase in the minimum wage is something that's always controversial whenever it sort of comes up to the surface of the political discussion. So what's being discussed right now is an increase in the federal minimum wage to $15 in sort of annual increments up to 2025. So it's a gradual increase to that $15 level, but it would be a substantial change for millions of Americans. Because this is proposed legislation, it's something that gets scored by the Congressional Budget Office. And so we have some pretty reliable data, I think, about the potential impacts of this increase. And no surprise, I mean, there are winners and losers. There are people who would lose their job because at this federal this level of minimum wage, where they wouldn't be providing the value that would justify their employment. And so the CBO expects that we could see 1.4 million workers lose their job under this legislation. But on the other hand, there are people who certainly would be winners of this. Those are people who are being paid below that $15 level today, who would see an increase in their wages. The estimates by the CBO are that we could see almost a million people lifted out of poverty by the passage of this legislation. Cumulatively, we would see perhaps pay for not just people who are below that $15 level now, but people who are perhaps just above it. There's quite a wide range on the wage spectrum who would see a change in their wages from an increase in the minimum wage. We could see overall cumulative pay increase by $330 billion over the next decade should this legislation come to pass. And so that's a pretty significant increase in spending capacity in the economy. And then finally, the spending bill doesn't have a significant impact on the debt and the deficit. I mean, for the people who do lose their job, we would expect that there's going to be some additional unemployment benefits paid to them. But the overall impact on the debt and deficit is small. The CBO estimates that over the next decade, the federal budget deficit would only increase by $54 billion. That's a pretty small increase over a 10-year period. So, I mean, this is a discussion that economics is not particularly good at handling. It's something that is a political process that will work out. There are certainly winners and losers, but there are that's a political discussion that ends up taking place over whose priority should be put ahead of who else's. So I would say that from an economic perspective, it doesn't have a big impact on the debt and deficit. It would have a marginal positive impact on overall consumer spending.
Okay, thanks, David. Sticking with you, got another question for you as well. I mean, a topic that's been discussed lately on financial media and among market participants is, whether or not the proposed stimulus, recovery plan is really necessary, just given, some of the signs of improvement we're already seeing. Can you maybe give us your views on that?
So as to whether or not it's necessary, I think the shortest answer is no. I mean, we looked at the CBO's estimates of the output gap, and we do see that the output gap should close over the next 5 years. But there is potential through additional stimulus that we could close that output gap faster. And as I said, the 1.9 trillion, I don't think that the end amount that passes into law will be quite that high. I do think it'll be somewhat lower than that. But it's important to remember that in that amount, it's not just all stimulus. There's some of that is continued economic relief for the nearly 20 million people who remain unemployed. And so sort of those that sort of spending can actually be considered more like relief, continued relief for those who are affected by the pandemic in terms of their employment status. And then finally, for the remaining portion that actually is stimulus, one thing that people I think should keep in mind is that $1 of stimulus doesn't translate one for one into $1 of economic output. There is something lost. Estimates during the pandemic suggest that $1 stimulus has turned into about 60 cents of additional economic output. So those are all things to keep in mind. It is not necessary, but I think additional stimulus does bring forward the time when the economy will be back to sort of firing on all cylinders, and we can get people back to work and consumer spending as they normally would.
Thanks, David. All right, Jeff, I think I'm going to mix a couple of questions here that we're getting from some of the attendees. And I think, I think it goes back to what you're pointing out. Valuations seem stretched. A lot of stocks have surpassed, pre-COVID levels, but there's also a lot of companies out there that, have been impacted more severely by COVID that, haven't seen their share prices return to levels such as, hospitality, entertainment industries, or, maybe large construction firms, industrial firms. Eventually between immunity and vaccines, how quickly do you think that some of these stocks could come back? Like for example, like travel and hospitality, and how are we viewing that? Are we looking for opportunities to participate in that rebound?
Yeah, no, it's a great question. We do, it somewhat goes to the value versus growth debate out there. But I think you need to look at it a little more granularly in the fact that, there's going to be some winners and there's going to be some people that just, aren't able to recover from the downturn that's occurred. But as we do start to open up, I think, as David kind of pointed out in his, presentation, spending on services has been really depressed and continues to be depressed. And it's likely that, we're going to see people want to get out to restaurants, and we want to get back to traveling. We want to get out and utilize some of the stuff that, it returns life back to the normalcy it was before this whole pandemic. And the way we're definitely looking at names in those areas and who will benefit from those. But I think it's going to be a process. And, David has talked about this in the past, that, I think that people are going to, step out and maybe be more comfortable going to their, restaurants first before they're going to be comfortable with jumping on an international flight. It might be that they're more comfortable doing domestic travel before international. And then it might be, further down the road that, people finally get comfortable enough to jump back on a cruise ship. So I think you have to look at, how the cadence of this reopening and the spending is going to occur. But going back to, the excess savings that's occurred out there, I think there is probably more positive surprises that are going to occur over the next year with respect to a lot of these companies, and we start reopening. I mean, just anecdotally, I know a lot of people that I've talked to just can't wait to get out and travel again, and can't wait to get out and have more of the social interaction. And so I think that there is a lot of pent up demand. I also think that there is the resources to do it. It's just, I think it's all going to be key on the vaccination schedule. But, I think it is a great question that even though the market's at all-time highs, there's definitely some stocks out there that are still, very cheap when you look at it from more of a normalized operating environment. It's just kind of going through those names and making sure that you have a company that has the financial resources to weather kind of this drought that we're currently in with them, and then able to capitalize on the recovery once it does, I guess, take hold in earnest.
Sounds good. And it looks like we're getting close to the end here, but we got one more question I'd like to ask. I'd like to put to you, Jeff, more on the fixed income side. So yeah, obviously, given low interest rates, overpriced bonds, other economic uncertainty, high equity valuations, how are we thinking about preserving capital for those that may be more risk averse or, are looking for more income? Are we thinking about preferreds, munis, or how do we think about preserving capital, just given the environment we're in?
No, absolutely. Now, here, I said earlier, this is really a tough market to be in on the fixed income. Earlier last year, we were really excited about preferred stocks. They really got thrown out to the woodshed. The interest rates on those were really high relative to the market. But going back to our seesaw analogy, I think you have to understand the length of maturity of a bond kind of moves you out from the pivot, the fulcrum on the seesaw. So stuff that is short term in maturity, kind of really close to the fulcrum. So when the stock market, or I'm sorry, the interest rates move, the price of the bonds and the securities don't move. Now, preferreds, depending on the call structure on them, a lot of them are callable, but depending on the call structure on them, they can be very long dated. And so I think you have to be somewhat careful on the ones that you buy there. And I know we look at, certain types of preferreds that have closer call schedules. So they're not sitting way out on that seesaw. So when you see interest rates start to move, you get, more dramatic of price movements. It is one of the reasons that we are a little bit more positive on, the high yield. High yield tends, as I said earlier, tends to be shorter in its maturity length. And so here again, that means it's sitting closer to that fulcrum. And so as interest rates move up and down, those bond prices won't be moving as dramatically as stuff that's further out on the maturity spectrum. That coupled with a recovering economy, investing in a high yield basket of securities, I think, is probably one of the better choices. The other choice too is, just as to assume that, interest rates are going up, you just invest in shorter term bonds, and you might have to give up, some interest for the next 1, 2, 3 years. But as those, securities mature, you're going to be able to roll those over and hopefully into higher paying interest rates. Now, the problem with that is I don't think anybody's anticipating interest rates are going to be going back up on the Treasury to 4, 5, 6%. So we might just be stuck in a low interest rate environment. Furthermore, if inflation does pick up, locking in interest rates in a fixed income environment, it's a fixed payment stream. And so those payments lose their purchasing power, and that's one of the reasons that we're a little more positive here again on dividend paying stocks. A little riskier, but dividends normally increase every year, and so if inflation picks up, you're not necessarily locked in on a fixed income stream, but one of which that can grow along with the economy. So it is a very, very hard environment. You have to really balance your risk return on there. And unfortunately, the returns are really paltry right now. So again, I would just caution you not to invest really far out on the maturity spectrum right now, just because jumping for yield by going out and investing long term is just locking you in on these low interest rates.
Thanks, Jeff. So unfortunately, it looks like we're out of time here. I apologize for not being able to get to every single question, but I'd like to thank both David and Jeff for providing their views on the economy and markets. Just to remind you guys, we did record this this video, so we plan on making it available on our website within the next couple of days. And so if you guys have any other questions, comments, or suggestions for future presentations, and we would encourage you to contact your portfolio manager or business development manager. And with that being said, thank you for attending. We hope you have a great day.